Welcome to the Trader Continuum live broadcast. My name is Wes Walton.
I'm Gordon Scott.
We didn't even rehearse that ahead of time, so that's pretty awesome. Today is Thursday, May 17th, and we'll be talking a little bit more about the STEP program, and we'll also be talking a little bit more about some cool market stuff that's going on. But I suppose we'll get right into the step-by-step program primarily. But just a reminder to everybody who is here live, you are more than welcome to type in your questions in the little chat box, the little chat window. Click on the little, dialogue box blurb thing, and then you can chat with us live. You can ask questions, you can do anything you want on there, within reason. But just keep in touch and ask questions as we go along, because we'd love to hear from you. Interaction really helps things go, smoother, I guess. Maybe not smoother, but makes things a little bit more interesting and fun. So that's what we really want. So I am going to turn this over to you. What do we want to do? Step three. Perfect. And let's go ahead and start this baby up. Sweet. I'm just going to minimize this real quick, and we are golden.
Wonderful. Well, as you know, if you've been following us the past couple of days, we're talking about the core concepts behind the Trader curriculum and all of the things that are going to be trying to guide you through as you learn your way through the art and skill of trading, and particularly trading to really be worth your time and to try to make significant money year after year with your trading activities, be they full-time or an avocation. And we're going to talk a little bit about the difference between those two and how you go about working through that choice in this third part. The third part, of course, is to engage your strategies that you've both learned and tried out, engage them with your money, and prove that they are worth your time. That's what we're attempting to do, and we're going to talk specifically about this. So engage and evaluate is kind of the topic here. It is important when you engage in your trading system that you work with a broker that you like and chart packages you trust. I really should have added a third bullet here, and that would be trading in a time frame, in an amount of time that suits you and that you like. In fact, let me just talk about that directly now and sort of say, if you're thinking about trading and you can't quite decide what you should be doing, here's a couple of simple algorithms or questions you can ask yourself to make this decision. Do you want trading to be your full-time only business? That's just what I want to do. And so I'm going to spend most of my day trading, right? Or do I want my business, my trading, to be more like an avocation? It's kind of a hobby, but I don't want it to just be a hobby like most other hobbies that takes money. I want it to be a hobby that makes money for me. But I kind of want to spend hobby time frames, 5 hours or less a week on it. Now, either of these approaches to trading realistically can do well for you. The difference is going to be how you allocate your time and the kinds of things you try to trade. So let's look at the first one. If you want to spend your time trading most of the time. Now, some people feel like, well, I want to do that because I want that to be my career, and I got to have a career, so I want to do that. And I'll make more money doing that if I can do it well. Surely, that's true, right? Well, yes and no. I mean, if you have a productive trading system and you make a whole bunch of trades, then the faster you make more money. That's good. But some of the best traders in the world don't really spend all day trading. They do spend all day watching the markets and trying to learn and do a bunch of things, but the actual trading activity is the small amount of execution. And so it's really not the case that you have to spend all your day in front of the computer clicking away. And in fact, for some people, yours truly included, If you spend all day clicking and trading, your biggest risk is the potential to over trade. In other words, you make some really good trades, but then your trade quality deteriorates. And in that deteriorated state, you're not getting the returns you want. It's sort of like, if you are trying to play a sport and you like that sport, your first hour of playing it, you can perform well, but the second hour you'll be a little more tired, and then so on and so forth as you go, depending on what kind of sport it is. But if you were continuously playing the game, you imagine even a pro soccer player plays a 90 or outside of the U.S. football, right? A 90-minute running game, and then they're just exhausted at the end of it, and then they have to go step over to this next door stadium and play another 90-minute game. Do you think that game is going to be as well played as the first? Well, seems obvious to say not necessarily. For the most part, you can expect that it would be of lower quality. Well, that is often true for intraday traders. Depending on how you structure your time, if you're going to trade short-term intraday in and out, day trading, then you need to make sure that your first trade and your last trade can both be made with the same level of quality. The way that happens is usually that you structure your kind of trading where you're actually looking for a lot of potential, and you're being very patient, and only when and if and only if those conditions occur that are high quality, you take them. And then the rest of the day is bird watching. It's being patient. And that's hard. That is hard to do. And when I mean bird watching, I don't mean looking out the window. I mean watching the little blinking lights on the screen. But it's essentially no different from waiting to capture the picture of that incredible rare bird, right? You're looking for the rare bird in the stock symbols. That kind of thing is hard for most people to do. Most people just don't find it enjoyable. And when I tried to do it, I found that everything looked like a rare bird. Trade that, trade that, trade that. And I found that when I backed off and said, all right, what if I spend my day actually teaching other people what I know, and then I just hold an hour a day available to myself for trading? When I did that, my trading results dramatically increased. I had an 80% year the next year after I started that. So it was really a lot better for me to trade in this sort of avocation way, but still spend a lot of the time looking at the markets and researching and teaching other people about them and so forth. So that's the methodology I've continued to use throughout the years, and that's worked well for me. I find actually that works for most people, but not everybody. And of the people that can actually intraday trade and be very careful and be patient and respond only when a good trade, there are a greater degree of them in the world of trading because they've selected and so I don't try to prejudge anybody when I'm working with someone to learn how to trade well. You could be either way, but just know that if you're new at it and you find it to be tedious to sit in front of the computer for hours and hours a day, you're probably in the secondary camp where you're interested in trading, maybe for an hour a day, maybe 5 minutes a day, depending on what's going on. But you like keeping up with headlines, you like keeping up with chart, and you like studying and learning about the stock market, and you really like learning that whole idea of managing risk and getting larger reward from it. That to me is the most fascinating part of all of this, because that is transferable knowledge. If you could find a way to start a business by eliminating big risks, taking small losses, and then just letting the big winners come when they come along, you could be successful at that business. If you can do that in a relationship, if you can do that in a marriage, if you can do that in personal interactions through just meeting people walking down the street or walking around in a park, if you have the ability to do that, then great things can naturally come, because there's good and bad everywhere, right? If you limit the bad and you don't limit the good, you've got a method for success in life. I was musing earlier today. Well, I'll get to that later. Let's come back to this and say, so your idea is to have this methodology where you see the trade setup, you plan your trade, and then you execute it. And it's so important you track your trades. By the time it's done, I'm going to sound like a broken record on that point, tracking your trades. You get started by risking small and then slowly increasing. Okay, so let's talk about planning your time around this idea. I really like the idea of trading when you're just starting to learn. Trade in the last hour of the day, especially if you have an account size of $25,000 or less, because then you can put on a trade and let it go overnight. And you don't have to worry about, you know, the day trader rule and you know, getting your broker all wrapped around the axle and giving you these warning messages. You can't, you're a day trader, you don't have $25,000, right? But even if you do have more than $20,000, you got $250,000 or more in your account, it's nice to be able to come at it at the end of the day because the prices are not so squirrely. They're you know, in the last hour of trading, but they are moving fast enough to get a good and liquid price, and you know, so you can get a good price even if you're doing an entry, a market order for entry, and that's fine. And but what you want to do is you want to get into this pattern of consistently executing your trades in the same way, whether it's market orders, limit orders, or buy stop orders. And so you want to be doing that. And then you risk small. That's usually 1%, but the larger your account is, the smaller that percentage is. So if you're, let's say, $1 million, then you probably only want to risk 1/4% of your account. So instead of $10,000 a trade, you probably only want to risk $2,500 per trade on $1 million account, just as an example. If you're around $200,000 or so in your trading account, then probably 0.5%. If you're under $50,000, then absolutely 1%. If you're under $10,000, then you might have to risk 2%, but it would really be best if you just paper traded until you got this down rather than risking, because under $10,000 you end up paying a higher proportion of your trades on commissions. So that's what that's all about. But so you start, and when I say slowly increase, think of it as you know, somebody who's in the hospital recovering, and you're trying to build up their immune system. You don't want to get out of the hospital too soon, you know, because if all of a sudden you start responding, you start getting a cold your first day out, and you're going to be right back in and on an IV, you know, you don't want to be doing that. Your idea of risking small, you start with a small amount of risk, 0.5%, say, and then when that goes good, once you realize, hey, I got 30 trades and I got a high expectancy, like we talked about in the last one, then great, now I can go ahead and step up to 0.75% or a full 1%. But whatever you step up to, it's got to make the feeling of trading the same. I had this one coaching call where I was talking to a guy on the phone once, and he said, "Can you give me an idea of what this stock is going to do tomorrow?" And I said, "Well, what do you mean? It's going to go up and down." And he said, yeah, but how much? And is there a possibility that it could go down? I said, sure there is. I mean, anything could happen. It's stocks. He says, but do you think it could go down 25 cents? And I looked at the average true range, and it was like 55 cents for that. I said, it could go down 50 cents. He said, 50 cents? That'd be terrible. You think it's going to go down 50 cents? I can't afford it to go down 50 cents. I'm like, what are you talking about? Why are we having this conversation? Mm-hmm. The stock moves 50 cents every day. What is your? He says, yeah, but you know, it has the setup. It should go up from here and only up, right? Like, no, that's trending. It's generally going to go up, and you got to allow it to. I mean, what are you worried about here? And he said, well, I just don't think I could afford it if it went down 50 cents. And finally, I said, all right, wait. Tell me how many shares of this stock you have. He said 25,000. I said, okay, 25,000, great. So it was a $20 stock. I said, how much do you have in your account? And he said 250,000. And I said, whoa. So you're telling me you're fully margined. You have a $500,000 position on this one stock. Your entire account is doubled up in that stock. He said, yeah, is that bad? I said, well, no, unless you're worried about the fluctuation. So we're talking about 50 cents. You could, with this size of a position, you could lose $12,500 tomorrow, I mean, you could be down that much, and that's assuming the stock doesn't, take a nosedive and get in a downward trend. That's just its normal fluctuation. It's going to be down, 25 cents, half of that, so you're going to be down $12,500. It's like, I can't. I said, now the fact that you're stressing over that tells me you've got too many shares on. It's like, reduce the number of shares until you can sleep at night, until you can just go to bed and not worry about it, not be checking the quotes at midnight, and as if somehow there was after hours information you can get. And you know who you are if you've been there. I've been there. No judgment. That's when you have too much on. It's not when you made a bad decision. It's not when the stock's going against you. It's that you have put too much on your trade. So that's the way he was, and I was like, you got to back off of this. And he says, well, but then I won't make any money. I said, yeah, you're going to make any money now? I mean, you're so panicked. As soon as it drops 30 cents, you're going to sell, and you'll lose that much. Far better if you were to cut the position size by a quarter, and you're not worried about it, and then you can let it ride $1 higher, and you'll make more money than you could have possibly lost under that connection. So that was an important lesson for him to learn, and that is kind of what the small risk is all about. You do something that doesn't bug you, and then you increase the size, and if it bugs you, then you can't go there. You got to move back down until you get more experience. And then each time you move up. So I worked with one gentleman for a year. He had an expectancy of 0.16, 16%. And he made something like 60, 70 trades a month. So he was a very active trader. He had a full-time job, but it allowed for gaps along the day. He was a contractor, and so he had an hour here or two in the day, and so he was a very high frequency trader, and he would use those gaps. But he made a bunch of trades, and his expectancy was still very low. So he was working really hard for not a lot of money. Brokers love these kind of guys, right? So they create a lot of commissions for them. But so once we started realizing what really matters and helping him concentrate on just a few methods and reduce the number of trades, he got his expectancy first up to 25, then to 30, then to 37, and he started with a 1/4% risk. He had like a $112,000 account or something, and he started with 1/4% risk, and then he went through about 50 trades, and then he got that higher expectancy. And then he went up to 0.5%. And when he went to a half, it was no change. He was able to make the same kind of decisions, not get freaked out. And then he went to 3/4. And then finally, after 3/4, he made it to 0.67 expectancy.
Whoa.
Yeah, that's really good. 67% on 100 trades. And he's making about 60 trades a month, right? So, but although he had dialed it down and now is making about 30. In any event, once he got to that level and would start trading the full 1%, then sure enough, the following year, he was able to double his account size in just that year. And now all of a sudden his trading made sense. I mean, he was making so many trades and making so little money. Now he's making fewer trades and making a lot more money because he had this consistent process. He was able to see, plan, execute, and slowly increase so that it didn't change him. So the next idea then is for us to recognize, okay, there we go, that we do need to execute consistently. And to do that, you plan before you trade. What is my entry? What is my exit? You actually record them before you get in the trade. Then you use the same pattern of orders. I'm always going to use a buy stop order for this kind of execution and a limit order for that kind of execution, so forth. It's a mistake if you don't follow that same order pattern. It's not a mistake if you lose money. It is a mistake if you lose more than you planned for because of slippages or something, or for whatever reason. Or if you didn't set your stop. It's a mental stop and you didn't actually get yourself out close to the price. You'd be like, oh, I'm going to wait another day because I'm sure it'll come back. But no, it goes down lower. That is a mistake, a big mistake. It is a mistake if you make a big winner on an accidental trade. Now, that doesn't mean you can't be happy about it. You can be happy about making a lot of money and getting lucky. But you have to acknowledge that's a mistake. And therefore, I can't plan on it. And so I have to be able to make trades where I don't make mistakes because those are the trades I can plan on. So we mentioned risk management. You start 1% or less and you model your trading. You increase to 1.5 or less very carefully. Now this is really where it gets awesome. Once you're able to get past 1% and you start risking 1% or 2%, very hard to do if you have a large account because you start seeing that money fluctuate a lot. It's really cool to do once you get in the win column. Like let's say you've got $100 to $1,000 plus in your account and you've got a good year. The first 6 months you're up 20%. You're at 120,000 after 6 months. Well, at that moment in time, if you increase to 2% and you start having continued success, imagine the next 6 months, instead of just making another 20% and going to 40, imagine you doubled that, right? And so you come out with 160. And so that now you've got what was a great year at 40% is a stellar year at 60%. And you could do that because you're thinking, hey, I started with 100. Anything up here is bonus, right? Well, the difficulty is if you get in a losing streak right at that point, and then all of a sudden you drop down really fast, you got to go right back down to 1% or less and be disciplined, et cetera, et cetera. So you're always on the hunt for opportunities to risk more than 2%. You have to do that carefully. You can only do that when you have these situations where you've got kind of a windfall and you're risking some of the profits from the windfall and you feel like you've got a new opportunity here, and for a short period of time you're going to load on extra shares, knowing that if you risk, it's just going to put you right back to where you were at the start of the trade or a little lower, and you're okay with that because that is still in the positive column for the year or for the quarter or whatever you're measuring on, right? So because if you can get up there and you can actually risk something like 3% of the trade on a trade where even if you lost it, you still have, say, 5% profits for the year in the account, that's really big. Yeah, you'll lose some of those, but the ones that you make will just rocket you forward. So those you're going to be very, very careful. You can do that very rarely, but you're on the hunt for that. And so that's where risk management is. Risk is actually the same as opportunity management. Now, how do you model your system? I want to show you a spreadsheet which will be available to subscribers. A spreadsheet I developed, which is really cool. And do we have the spreadsheet here on your system? I think I downloaded it. I hope I did. Anyway, the way you do it is you analyze all of your trades into 6 different buckets. 3 divisions of the winners and 3 divisions of the losers. So we showed yesterday, how you record your trades and how you get 30 trades. So let's suppose you took all the winners and you say the top percentage, of these are all on average, 2 to 1 risk. So a third of my trades, or maybe even just a quarter of my trades, are a quarter of my winners. A quarter of my winners return double what I risked, and then about the same percentage, another quarter of my winners return about the same amount that I risked, and then half of my winners return about half of what I risked, right? So just 0.5 reward to risk to reward ratio. And on the other side, losers, same kind of thing. Maybe half of my losers lose everything I risked, and then a quarter of my losers lose 1 1/4 of what I risked, and then a quarter of my losers lose double what I risk. So I would put those numbers in my system, and then I would see, what does a system like that look like? Do you see anything called Modeler SS? Mm-mm. Okay. While you're doing that, is there any way you can bring up just an email client then, and I'll.
Never mind. Got it.
There it is. Yeah, Modeler 5. Okay, wonderful. Wonderful. Okay, I'm really excited to show you this. This is a very powerful tool, but it's going to take a little bit of time to sort of stare at it and realize what it's showing you here. So Wes is going to bring that over to the screen, and I'm going to then have a chance to work with it in front of you here. All right. Yeah, if you could. Yeah.
Zoom in.
All right. Yeah, let's go ahead and go a little higher. One more. There we go. That'll do. All right. So if I could take the keyboard there, let me show you what you would do with this spreadsheet. So let's say here's my starting capital that I want to work with. And let's suppose I have $50,000 in my trading account. And let's say I'm going to start with 1% risk per trade. And now I mean, don't worry about these charts here for right now. Let's see, series 1. Oh yeah, markets money threshold is going to be 50,000. I'm not going to actually discuss this one right now. So every time I'm changing, you're seeing these numbers change, but hang on a second, you'll see what I mean. All right, so once I look at my system, once I look at my trades, I look over my 30 trades and I say, I want to divide these into 6 buckets. This win-loss distribution helps me recognize what it is that I'm interested. I mean, how am I going to model what my results are? So let's suppose that this percentage is the total number of all of my trades, okay? And these numbers here have to add up to 100. So let's say I win fewer trades than I lose. I lose something like 60% of the time. So I'm going to say 40% of my losses are -1, meaning the amount that I intended. You know, that's where I set my stop loss. And then I get these weird situations where I get a little slippage, and let's go with 15% there. 15% and a little slippage, and it's -1.2. And actually, you know what would be more realistic is if I put 40 here, made that a -1, and then for some trades, see, I want to reduce my risk, and suppose I'm able to keep about, you know, some of these, whoops, -0.1. Now we'll go 0.2. All right, so about 10% of the trades, or in other words, 1 out of 5 trades, I'm actually able to reduce the amount of loss, or even make a scratch trade out of that. And then the last one, 10%, there's these ugly surprises where I lose double the amount I'm risking, gaps or whatever. 10% is actually a rather high number, but let's suppose that's what I'm up against, all right? Now, on the other side of the coin, so this is 60% of my trades are losers. Now I'm only going to talk about winning 40%, so that's 20, 10, and 10. Let's go 20, 25, 10, and 5. That's a little more what typically happens. And let's say that 25% of the time I only make 0.7, 7/10 of what I'm risking. And 10% of the time I get some really nice trades, and they come out, well, we'll leave that number right there, 1.855. But about 1 out of every 20 trades really pays off. And on average, I'm making 4 times as much as I'm winning. Okay, under this particular scenario, amazing as this is, it's a losing system. My expectancy is 0.06, almost break even, just a tiny little bit less than break even. So these results aren't good enough. If I went through 30 trades and I analyzed them like this and I said, this is what I come up with, well, that's not good enough. You've got to find a way to cut down on these losers. Well, let's say I look at it and I say, you know what, I can just actually use stop losses and stop using mental stop losses. And so then let's say that reduces this to a -1.1. And what does that do? Okay, well that's pretty good, because now I go from negative to positive, but it's still like 3% after 100 trades. All right, what if I were to make it so that the majority of the time I'm actually winning as much as I'm risking? Okay, great. We're going to change that one to 1. And then let's say to do that I have to sort of give up some of my biggest winners. Notice even these small changes are really helping, right? I get here to 5.5%, but it's still not really, you know, where I want it to be. So I've got to find a way to create more big winners. So let's say I sit back and I think, all right, I'm going to actually take some huge trades that I pyramid into. I increase the size. And by doing that, I create this kind of dynamic where I get something like, about 15% of my trades are big winners, and the biggest ones are really big winners. Then all of a sudden, look at where I am, an expectancy of 0.37, right? So anyway, this helps you recognize how you're modeling it. And the nice thing is that over here, we're looking at a couple of different charts. This one is if you started with $100,000, and the other one's if you started with $50,000. And it shows you up here what is the standard deviation and the greatest drawdown. In this case, it's 5%. In this case over here, it's 11%, and so forth. So now what I do, once I have a system that models what I have done in the past, then I can just, all I actually have to do with the spreadsheet actually is click the delete button in a blank cell, and that recalculates everything, or hit F9 to recalculate, whatever. And so then all of a sudden you see the numbers change. Each one of these represents about 110 or 120 trades or so. And so, it's like each one is a whole randomized set of 120 trades. Well, you can see at 0.37, there's very few of these scenarios that actually go below my starting point. A little bit ago, we saw 48 on 50,000. And so that was, 2% low. This is an interesting outcome. Look at this. See, you go a little ways, and then all of a sudden you get this big winning streak at the end that really increases the earnings. So that's kind of surprising there, right? So anyway, you have well, if you just hold it down and watch it, it'll blip a whole bunch of different patterns, but most of all of them are positive, and great. All I have to do is trade this system exactly as I have in the past, and it will be a positive system. Now, most people don't get this kind of returns, but at least not at first. But that's exactly what you're trying to do. You run through your trades and see, like here, this is the other thing you want to do. You want to trade the system so you know what to expect. Here, this shows us the greatest drawdown is 26%. And you can see where that's happening, right? That's this area right here where we go from this peak down to this area down here. And that's 26% off the peak. So in order to trade this system, you've got to be ready, you've got to be willing and able to weather losing 26% and still be okay with that, still come back and keep trading, right? So this is the kind of information this modeling software spreadsheet will allow us to do. And so when you're engaging, your big thing is to use real money, get at least 30 trades, and then come in here and model it and say, all right, if I keep trading like this, where am I going to be in 120 trades? What's likely to happen? This is what I did the first time I got out of the bird watching moment and clicking on everything and trying to make 200 trades in a single day. That's not an exaggeration. I actually used to do that. But instead, make something more like 3 to 5 trades a day, and swing trade just 1 hour a day. Before I started into that, I modeled this system, and based on my calculations, it looked like I ought to be able to come up with a 60% return. And so then I traded that system for the rest of the year, and I came up with an 80% return. So it was even better than what I expected. And so I really feel comfortable recommending that you go through these kinds of exercises. And but like I say, this will be part of the subscription, and walking you through this, teaching you how to do this. That's also a part of what our content will be in the Trader Continuum subscription. So that's it for our part 3 today, how to engage and evaluate.
Awesome. I was just going through all of this really cool stuff that the live stream app can do. Sorry, I was paying attention, but at the same time, like, I've had this up so that I could see, when people chat and everything with us. Let me get this. Let me bring it up here. There we go. So I was playing with the live stream app on my iPad, and I I was, trying to keep track of all the chats that are,
Yeah.
that, we would like to see coming in. And then I realized there's this little button up here for picture-in-picture. I was like, oh, well, that's kind of cool. Picture-in-picture. That's nice. And then I exited because I was going to go look at something else, and I realized, look at that.
It's right there.
Can you believe that? Picture-in-picture on the iPad. Look at this. So whenever you are like exiting out of live stream, we can still see ourselves down here.
Awesomeness.
Sorry. If you are watching from a computer, just realize that you can actually watch from an iPad or an iPhone or whatever. And apparently, it even, if you got the live stream app, it even does this picture-in-picture thing, which is that is just fantastic.
That's great.
I won't spend any more time on that. I just wanted to throw that out there really quick. And let me make sure that this isn't going to bother us in the middle of anything else we're going to be talking about. Okay. Let me close that. Put that right there. And come on. There we go. Still want to make sure that I can keep up with chats. Okay. Let's go ahead and take a look at some market stuff. Did you have anything planned for market related
Remember, we had
things?
3 trades we got to look at. We just sort of teased 2 of them. The one stock you can buy that will actually benefit if interest rates go up, and we talked about the Disney trade yesterday.
Yes.
But we also talked about Apple as a possibility, and so
Right. Yeah.
we want to look at Apple, why it's an interesting trade, and we want to look at the interest, which is actually TD Ameritrade. So we're going to talk about both of these trades, why you want to look at them. Quick disclaimer here: educational purposes only. These are not intended to be recommendations for you and for your account. You have to do your own due diligence to determine whether or not you would think these trades are suitable for you. But these are the kinds of things to think about when you're reviewing trades. And so as I go through and talk about this, it's going to help you have better ideas for how you can be evaluating your own stocks and your own trades. So let's see if I can go there and get AMTD.
Hold on one moment. There we go. Okay, AMTD.
All right. So if you've heard that interest rates are going up, and by now most everybody has, and the TNX, quickly put me at TNX. TNX is the 10-year note, and as you can see, well, we're hitting a new high today, and in fact, this is actually kind of a scary thing in one respect. If you don't know about this, if you don't know about interest rates and what they've done over the past 40 years, then, well, you probably have been renting for ages. But most people are acutely aware of how, let's see, that's as much as I can. I'm going to go to a weekly chart then. Yeah, there we go. So you see this long-term downward trend? Imagine drawing a line. Well, in fact, actually, let's do better than a line. Let's put on a, where's our, no, it's not there. Is it in here?
Yeah.
The regression line?
No, it would be up in the drawings part, I think.
There it is, regression trend.
Look at that.
So we start here at the top, and then we go to just before now. And, give us what is the trend. So this is the regression. This is a statistical study, starting from the peak, going until, just the most recent peak right before it kind of broke its downward move. And see, this is the higher trend, right? So if we were to extend this out, you can see that what we've done just now, just in these past month action or so, let's do this. Let's extend the lines. Just in the past, about month or so, we have broken through that trend, that regression channel. And this is, this regression study, if you remember high school statistics at all, I didn't take statistics. I don't.
Remember.
And if I did, I wouldn't remember it. But over the years, I did take a master's degree and had to take statistics then. But what they teach you is that this is a way of a linear regression is a way of dividing the data, any set of data. And it comes in really handy for stocks because it creates sort of your baseline projection. And so what you have is this line divides the data in half. Everything above it is 50% of the data, everything below is 50% of the data. And then if the line is sloping, that is a trend of the data. Well, interest rates have had a decided 40-year downward trend, and you can see that these lines here and this line here is 2 standard deviations of that data. And that means that 95% of all the data falls inside those 2 lines, or you can expect it to. And so with that in mind, when we notice that this is poking outside, just think about how rare that is, right? This is like, wow, this is completely not the trend. So, here's 5% of the data that's outside, and we haven't been outside that channel forever until now. So the question is, are we just going to come right back in and continue this downward trend? We very well might. But historically, interest rate trends don't go on forever. It is quite possible that this could continue and reverse up. I don't think so, because once you get the Fed rate up to like 4%, the Fed rate right now is 1.75, and that's actually the highest of all the major currencies. The U.S. is right now, which means that the Japanese yen, the U.S. dollar Japanese yen, is back to the carry trade. That's what that means. That means currency banks will be using the dollar-yen pair to collect nightly interest. So we should look at that sometime. Meanwhile, what's going on here is that this keeps going higher, and the higher and higher this goes without the economy getting wrecked, that is a signal to the Fed that they can raise their interest rates, which they really want to do because they need to make a bunch of money since they put themselves in such a negative position for so long, buying so much debt and having so much on their balance sheets.
Right? I hate to say it, but why don't we just talk about that now? The U.S. dollar, Japanese yen, and the carry trade.
Okay, let's run to that. But before we do, we got to go back to TD Ameritrade. So this is this huge risk that interest rates could go up. If interest rates go up, how do you benefit from that? How do you play that? Okay.
So just FYI, also, when you're on a chart, you don't have to click up here. You can just press TD.
Oh, that's true. I just hate that.
What is it?
AMTD. Sorry.
AMTD. There we go.
Yeah, I hate that pop up for some stupid reason. Okay, so that's why I always go up to the corner.
Well, we're also teaching everyone here who's present live, how to use some of these software programs.
Interest rates have been rising. This stock, TD Ameritrade, is a good company. They know how to make money. I used to work for TD Ameritrade, and so what I'm going to tell you is common knowledge to people inside TD Ameritrade. It's not insider information. It's also knowledge to people, analysts, who understand TD Ameritrade's business model. TD Ameritrade takes a lot of accounts, like retail accounts and so forth, and it's a company that likes to make money in multiple ways. So they do 2 things. One, they charge commission on trades, but they also make money just by holding dollars under management, in accounts. They do that by what's called the spread, the difference between the amount of interest they can earn on holding the money versus the amount of interest that they pay out for people who have accounts with them. And they do that because they are what's known as self-clearing. So they have a bunch of money, and when you make trades and your trades take 3 days to settle, then the money that they used to sort of reconcile bank accounts with that settlement is their own money. So they are insuring your trades. They are clearing they're insuring it during the process of it getting cleared. And there's nothing wrong with that. But what happens is because they're doing that, they're able to earn money on whatever account balance you have. They pay you a certain amount of interest, but that's not all the money they get. It's not like they're passing on the amount of interest that they're earning. They are earning more than they're paying back to you. There is nothing illegal or wrong or unethical or immoral or anything about that. It's all good. Charles Schwab does the same thing. The difference is TD Ameritrade does more of it than Charles Schwab does. So when interest rates rise, companies that have this business model, then they make more and more and more money with the spread. You can bet that their CFO right now is just rubbing his hands together, can't wait for the next earnings quarter, because with these new higher interest rates, they're going to be able to likely capture more of that money, just residual spread income. And as the higher and higher those interest rates go, the better and better their business model is going to be. Part of all of this upward move is investors and analysts comprehending that that's the case. And so they kind of got in there already, and it leveled out here when the Fed sort of said, well, maybe we won't raise interest rates unless we see. So this is literally the market having the expectation that interest rates aren't going to go up. But it's also the market not realizing exactly how much interest TD Ameritrade, how much money TD Ameritrade is going to be earning on interest. I think that, I mean, here, as we could see, their earnings expectation, the estimate was 51 cents. Earnings came in at 43. That was a little bit less. Probably a function of the fact that they paid a 21 cent. Oh, no, it's the same dividend. I thought they had increased their dividend. Oh, there it was, from 18 to 21. This earnings, that estimate was 42, and they came in at 52. Here, the earnings were 48 and estimated to be at 51. Of course, they estimated 51 because, gee whiz, they did 52 last time. Can't be too much different. The problem is that people, so this was for period ending February, right? This was for period ending November. So if you think back to last November, the market was going up strongly. And so people were putting money in and trading and doing all kinds of things. But here, the market dropped strongly. So the value of people's accounts, right at February, that was the low point, right? The value of money in people's accounts dropped. Therefore, the amount of interest was a lower amount of interest that they were earning. See how that works?
Oh, okay.
Yeah. So, but what has the market been doing since February? Going up, right? And because it's been going up, I think we can expect that their earnings in the future are going to be better than people expect. Especially if for the next month, earnings, the market continues to rise. So strangely enough, this could go up with the rest of the market, not just because the rest of the market is going up, because people literally think that this company will be earning more money in the interest spread, because more and more their account holders' value will be increasing. So that's one to watch. And generally speaking, it's going to be correlated to interest rates rising. I think that we're in a world where interest rates are going to rise as much as they can. I don't know how high they're going to get. If the Fed rate makes it all the way to 4%, it would bankrupt the United States, at least today, because we have so much debt that at a 4%, all of the taxes coming in would just break us even with the interest rate payments we'd have to make, which, once the world kind of got wind that that was where the United States was, we'd be in a world hurt, right? Interest rates would soar, because then people would require U.S. government notes to have higher returns. All right, so anyway, that's the understanding behind TD Ameritrade. Let's just have a look at Apple Computer really quick to notice. So it dipped down. That was a good buy. Back up in was according to script. Now we're back down a little bit. So if you missed that trade a couple of days ago, now you can reevaluate, because this range in here, you see, if you're making a purchase, you've got this as sort of a backstop, and you can put your stop loss underneath it. But if the market's going up, Apple's going to be making a new high. Warren Buffett is not a crazy guy. He didn't bet on Apple so that he can make a 3-day trade. He's in it for the long haul, and he just added, over the past quarter, he added $75 million of his Berkshire Hathaway fund to Apple. So that's just a quick note on that. Now, I think your suggestion is really good. Let's talk about the carry trade. You want to?
Well, we've only got 9 minutes left. Do you think we can cover the entire carry trade in 9 minutes?
The basics of it. I mean, we could certainly set it up for talking more about it later, but it's really a good idea, and it's something that people need to know about. So, I mean, do you ever look yourself as a currency trader at the dollar-yen pair?
Yes, I do. I enjoy looking at the dollar-yen pair.
Wonderful. Okay, so if this is new to you about the carry trade, anybody listening, then you're going to find this interesting, and you're going to find that it's probably interesting and worthwhile to be considered the case that the dollar will continue to rise against the yen for quite a while. If you were just to Google the interest rates of the major currencies, really quick, we don't need to do it here, but if you were to do it, you get a few links, and one of the pages that just sort of would show that the U.S. dollar is paying 1.75% interest. That's the Fed rate, right? So when you hold the U.S. dollar yen pair overnight, somewhere at about 6 or 7 o'clock Eastern time, right? There's that international date change on the currency market, and what you get is a small amount of interest. It's usually roughly the value of the spread, a pip or two or something, but you get that added to your account because the U.S. dollar pays interest and the yen has negative interest. What is that? It also pays you, but whatever the difference is, 1.75. If the yen were 0, then you'd collect 1.75% in annualized interest divided by 252 days or whatever it is. So
right. Well, and I guess that would make sense because if you are buying the U.S. dollar Japanese yen, you're actually selling the Japanese yen. So
right.
If they are charging interest, then you would be maybe not collecting, but you wouldn't be paying interest because you're selling the Japanese yen. You're not buying it.
That's right. That's right. You would actually be collecting negative interest if it was a negative number. I can't remember. Isn't the yen at a negative number right now? Basically, if you hold money in a savings account in Japan or any country where the currency has a negative, if you hold it in a bank account, instead of getting interest paid to your bank account, you get interest charged from your bank account. Cool. That's the way negative interest rates work.
Yeah.
Horrifying, right? I mean, but what does that do? That encourages people to get money out of their savings and get it into the economy and spend it, which is what the Japanese have been just crazy hoarders and savers of their money because, well, their economy's been so stagnant for so long, they feel like they have to do that. And so to try to encourage them to start spending their money and somehow increase the economy, they start penalizing people for saving by doing negative interest rates. Meanwhile, as a currency trader, then if you happen to buy the U.S. dollar Japanese yen pair, like say, 5 o'clock or whatever minute it is before the overnight interest payment, and then you capture that and then you sell it 15 minutes later at the same price, you've captured that interest rate, right? Now, selling it at the same price is pretty difficult because everybody knows that happens. And so, when that interest payment goes out, it sort of drops that same level because people are trying to capture that and sell it. So there isn't really the kind of arbitrage where he's like, I bought it here, I got the payment, and then I sold it in 60 seconds, and look at that, I made a pip for free. Doesn't happen that way. Because everybody knows that the brokerages adjust their spreads and sort of take that into account. It gets absorbed in the short term. But in the long run, day after day after day, it actually adds up. Particularly if as is the case right now, the dollar yen is trending bullishly. So in other words, every day you're holding this and it keeps going higher and higher and higher, you're also collecting an interest payment. You've literally got the wind at your back. And so people love those kind of trades in currency. And if you think you as a retail trader like that trade, think about how JP Morgan and Citi and Barclays and big currency banks, those that are member of the 12 or 13 interbank exchange, think of what they think about it, right? If you got $1 billion and you put it in the carry trade because you got to put it somewhere, where are you going to park it? If it is money, it is going to get docked. So if you don't have an investment to put it in, if it's just sitting in cash, you're like TD Ameritrade and you got all this self-clearing money, where are you going to put it? Put it in, well, that's where the carry trade gets its name, is that they put it in some currency pair and then it carries that interest over time. As long as they think that currency trade is not going to hurt them, trending, great. If it starts going down like it had done from the beginning of the year down to March, well, then they got to get out in there and hedge it. They got to get some futures going and stuff. But whatever. Either way, a large bank will have a large amount of money in the carry trade. And what happens is when you see interest rates change, like let's suppose Japan started increasing their interest rate and it became very close to the U.S. currency rate, right? Well, then the carry trade would move from that pair to a pair that had a wider differential, right? And you got $1 billion and you hold it overnight and you make 1 pip. I mean, you're talking about $10 million or not 10 million, $1 million, maybe $1 million. So that bank's collecting $1 million every night on interest payments, just because they had to have some place to put it. And oh, by the way, if it goes up in value, then they're really collecting a lot, right? So that's what the professional currency traders are paying attention to and trying to take advantage of. And so us as individual currency traders, we have to know that. We have to know where is the currency, where's the carry trade? Is it, right now it's this pair. And the more and more money goes into the carry trade, then the more it comes out of somewhere else. And when stuff comes out of the carry trade, then it has to go somewhere else. You have to sort of look, where is it going into? And if you can spot early on at the break of a trend in the carry trade, what is rising in correlation or in inverse correlation with that, you can usually get a really good trade working in your favor because it's got all that fuel, all that carry trade money, or at least a lot of it has to come out and go to, well, wherever it appears to be starting off with.
Now that's interesting. So the more people who are, like the more money that drops into like the US dollar, Japanese yen, the more people who are buying the US dollar, Japanese yen, the more it's going to rise, right? I mean,
right.
And that's not to say, even a lot of financial institutions don't have enough money to move the Forex market, because the Forex market
it's huge.
It's working in $5 trillion a day in volume. We're talking, you put $1 billion into that. That's 1/5000th of the amount of volume that flows in the entire market. So
yeah. And that's just during the day. I mean,
right.
People estimate that there's some $60 trillion in the currency markets, all told.
Yeah. So granted, one financial institution, especially us smaller, little tiny traders, like we can't move it at all. But everybody, all at the same time, many financial institutions. I mean, one thing that you told me was, if you had the idea, then odds are, 10 other people had the idea first, if not 50 or 100 or 1,000 people had had that idea first.
Yeah.
So if you're having the idea, you're not the first person to have the idea, especially when the rest of the people who are having that idea are very highly educated and this is their job to have that idea. They spend their entire time looking at all of this information just to get this idea. Right. So you're not the first person to have the idea. However, you can ride that idea, because since you are such a small fish, since we are all such small fishes, we can ride the idea. So if somebody already had the idea, odds are all of those other financial institutions also had the idea, and many other traders also had the idea.
Yeah.
And if they are all dumping their money into this carry trade all at the same time, then it's going to push the US dollar, Japanese yen just a little higher, and maybe even a lot higher, depending on how many people actually had the idea, how many financial institutions had that same idea.
Yeah.
There are a lot of people out there who have a lot of money that they need to invest in something.
Right.
And the currency market is relatively easy way to just throw a ton of money into something, or at least it used to be.
No, you can bet that macro traders like Paul Tudor Jones, whose fund has $10 billion under management or something. I mean, they got to find places for all of that.
Yeah, you can't
big funds like that,
and you can't buy a stock that way. You can't
buy $10 billion of Apple stock without moving that stock tremendously.
It will move that stock huge amounts.
Yeah.
So that's why you can't just put all of your fund into one stock, or even put all of it into the stock market.
Yeah.
Like you're going to end up moving stuff.
Currency pairs are places where, larger global macro players can go and have a chance of getting a bunch of money in and getting a bunch of money out without losing too much on the slippage. Not to say that that's all they do is trade currencies, but it's a major part of their strategy.
Yeah.
And so when a trend like that changes, there are several big players that will tend to respond to it. And because they do, it can create very tradable, sustained trends.
Yeah.
And so that's why right now, especially because the differential is so big. See, it was for a while the Australian dollar was paying higher interest than the U.S. dollar, but they've reduced, and the U.S. Fed has increased, and so now that's kind of flipped. And so as a result, this is the carry trade. And so as a result, now you can be watching for, so if this trend changes, what if the dollar stops going down, stops going up and starts going down for some reason? Maybe the yen, the Central Bank of Japan raises its interest rates. If that kind of thing happens, or if just people want to put more money into U.S. stocks or real estate or anything else, and they don't want to just park it in currencies, then we could see that trend change. So the great thing about this is if you're working on the carry trade and you're looking for trend changes, you can make a trade where you risk. Like, let's say we want to go short. Well, most recent top, there's my stop, fine. And if you're wrong, you get stopped out. But if you're right, big win.
That's interesting. I like that. Now, how do you actually look up interest rates? Like, what's the easiest way to find the carry trade?
Well, the easiest way to find the carry trade is to notice what the difference, what is the biggest difference among the currency majors, just the 6 pairs, the euro, the Swiss franc, the
British pound,
Japanese yen,
Australian dollar,
US dollar, Canadian dollar. Is that pretty much covered?
New Zealand dollar.
New Zealand dollar.
I want to throw in the New Zealand dollar.
Yeah, so I take the New Zealand dollar with a grain of salt because
well, the New Zealand dollar takes you with a grain of salt too. So
that's true. That's true. They're very salty people. No, what I mean is, there's not a lot of big banks that want to put a lot of money in the Kiwi.
Yeah.
Because it's the least liquid. I mean, it's pretty liquid, but it has the least liquidity of all the others.
Yeah.
So if they had a choice, right, putting money in the U.S. dollar compared to a quarter point differential for the Kiwi, they wouldn't make that choice. There's too much risk going into the Kiwi for just a quarter point. Right?
Yeah.
Now, some smaller players, oh yeah, they're all about that, right? But the big players, the ones that are going to make these extended trends occur and continue, they're going to choose the dollar, the euro, the yen, even the Australian dollar over the Kiwi. So anyway, you look at those 6 majors and just say, what is the differential? Yeah, sure. I mean, you look at the Mexican peso paying higher amounts, or the Spanish real or Brazilian real or whatever, right? Yeah, there are higher interest rates out there. Pay no attention. Nobody is going to put $1 billion in the differential between a South American currency and the Japanese yen. Well, people do crazy things. But generally speaking, the risk is so great for doing something like that a larger bank would not feel comfortable accepting that. Yeah. But they got to put it somewhere. So again, what's the safest? What is the perceived relative value? So you literally Google major currency interest rates, and half a dozen pages will come up, and pick one of them and you'll see the numbers.
Yeah. Okay, so we're going to go ahead and end on that note really quick. And actually, I want to continue this conversation after we end this, because I don't want this I don't want this recording to go on forever. So those who are watching this live, those who are watching this recording, it's been nice having you here. We'll talk more about all this stuff later, and actually I'm going to be talking to him about it for the next probably hour and a half. But regardless, thanks for being here.
Likes the carry trade.
No, actually, it's not the carry trade. I was just thinking about all of the ramifications of the interest rate type stuff. What we were talking about with the spread and all that cool stuff, dude. We're going to be getting all kinds of cool stuff going on here.
Yeah.
So, anyways, let's wrap it up. So,
let's wrap it up.
Thanks for being here. We'll see you tomorrow. Tomorrow, which is Friday, right? Tomorrow's Friday.
Tomorrow's Friday.
Yeah, we'll be starting this earlier. It'll be 11 a.m. our time.
Is that when we're gonna do it?
Yeah, something like that. I don't know. It's 11 a.m. our time. Yeah, because that's 11 a.m. Mountain Time, which is 1 p.m. Eastern Time, is when we'll be coming back for Friday.
No, it can't be that. It's got to be earlier.
Yeah, so it'll be 11 a.m. Eastern Time.
Yeah.
9 a.m. our time.
Correct.
There we go. All right.
That's what it is.
11 a.m. Eastern Time. That is when we will be meeting back tomorrow. And we'll send out a notification about that and everything, so don't worry about trying to memorize all of the random stuff we just said. And we will see you tomorrow. Thanks for being here, and goodbye for now. And fade to black, right?